What if I told you that your 50,000 Kenyan shillings today could quietly build a 10 million Kenyan shillings future without winning the lottery, starting a side hustle, or chasing risky crypto investments? That's the same 50,000 Kenyan shillings you'd spend on one luxury night out, a new iPhone payment, or a small holiday. But what if you redirected it into your future instead? That's the power of consistency, and today, I'll show you exactly what happens when you invest 50,000 Kenyan shillings every single month for 10 years. The secret isn't luck. It's consistency. Every month, committing 50,000 Kenyan shillings may feel small in the moment, but over time, it adds up. Think of it like planting seeds. A few seeds today don't look like much, but in 10 years, they grow into a forest. If you are a 30-year-old professional and you start investing 50,000 Kenyan shillings monthly in your mid-30s, it may not feel like much at first. But by year 5, you will begin to see momentum, and by year 10, your disciplined approach will create a solid financial cushion simply because you stayed consistent. Consistency works best when paired with systematic investing, also called shilling cost averaging. This means investing a fixed amount regularly, no matter what the market is doing. When markets dip, your money buys more units; when markets rise, you buy fewer. Over time, this smooths out the ups and downs and reduces emotional mistakes, like selling when the market crashes. Automation is your best friend here. Set up monthly contributions with your bank or investment platform, and you'll never miss a month. No excuses, no procrastination. Now, where can you actually put your 50,000 Kenyan shillings each month? Let's break down the main investment options in Kenya, and see how they compare in terms of risk and growth potential. I'll walk you through each one so you can decide which fits your financial goals best. First up, money market funds. These are like the safety nets of investing. They give you better returns than savings accounts and are very liquid, meaning you can access your money anytime. MMFs are perfect if you want your money working, but still within reach. Next, treasury bonds. These are government-backed, so the risk is very low. You earn stable interest over time, usually through your bank. If you want steady and predictable growth, consider investing in this asset class. Now, if you want something a bit more diversified, go for unit trusts or mutual funds. Here your money is spread across different investments, managed by professionals. The risk is moderate, but so is the reward, good balance if you're starting to branch out. Then we have SACCOs and REITs, a bit of a mix. SACCOs help you build savings within a community setup, while REITs give you access to real estate investing without buying property yourself. Moderate risk, but with the potential for consistent returns and long-term growth. And finally, direct stocks or ETFs. This is where the growth potential increases, but so does the volatility. You can invest through the Nairobi Securities Exchange, but remember, prices go up and down, so it's best for those who can handle the swings and play the long game. The key is to know where you are on the risk scale, and align your investments with your goals. You don't want all your money in one place. Even if you're young and can take risks, having a mix protects you when markets get rocky. Now that you know why monthly investing works and where to put your money, let's see what actually happens to that money over 10 years, with realistic numbers and different return scenarios. Let's do some calculations. If you invest 50,000 Kenyan shillings every month for 10 years without any returns, you would have 6 million Kenyan shillings. Not bad, right? But let's bring in realistic returns. Scenario 1, Conservative Model. If you play it safe, aiming for a 5 to 6% annual return, your money grows to around 7.8 million shillings. Scenario 2, Moderate Model. Now, if you're willing to take a little more risk, targeting 8 to 10% returns, that same monthly 50,000 Kenyan shillings can turn into about 9.8 million shillings. Scenario 3, Aggressive Model. And for the bold investors chasing higher growth, 12 to 15% returns, your 10-year investment could reach 12 to 13 million shillings. Notice how the difference is huge over 10 years. See how consistency and the power of compounding can turn 50,000 Kenyan shillings a month into serious wealth. Which scenario fits your investment style? Allocate 40% to stocks or ETFs, that's about 20,000 Kenyan shillings a month. This portion gives your portfolio the growth potential we all want. Next 30% in unit trusts or mutual funds, roughly 15,000 Kenyan shillings. These are diversified investments, so you get moderate growth without putting all your eggs in one basket. Then allocate 20% to money market funds or treasury bonds, that's 10,000 shillings. If you prefer bonds, save 10,000 Kenyan shillings every month until you meet the minimum threshold. These give your portfolio stability and liquidity, so you always have cash when you need it. And finally, 10% in REITs or SACCOs, around 5,000 Kenyan shillings. These are alternative growth options that can diversify your returns even further. So when you put it all together, this mix gives you growth, stability, and diversification, a smart way to invest without taking on too much risk. Stocks give you long-term growth, bonds and MMFs protect your capital, and REITs/SACCOs give you additional diversification. The goal is balance, growth with protection. As your portfolio grows, some assets will outperform others. That's why rebalancing is key. For example, if your stocks grow faster than expected, they might take up 60% of your portfolio instead of 40%. Rebalancing brings your allocation back in line and keeps risk under control. Here are some suggested investment models for young high-income earners. Let's break down 3 simple ways you can structure your investments, depending on your risk, comfort, and goals. If you're aiming for high growth and can handle some ups and downs, this model is for you. Most of your money goes into stocks, a solid chunk into funds, and a smaller portion into alternative investments. For a mix of growth and stability, the balanced model spreads your investments more evenly. You still get growth from stocks, but bonds and money market funds help smooth out the risk. If you prefer safety and consistent returns, the conservative model shifts most of your money into funds and bonds. Stocks are still included, but in smaller amounts, and alternatives remain a small addition for potential upside. Choose a model that fits your goals and risk comfort. Remember, these are just frameworks, you can tweak them based on your personal goals and timeline. Now that you've seen how 50,000 Kenyan shillings monthly can grow and how to allocate it wisely, it's time to imagine your 10-year journey. Let's walk through a full 10-year journey and uncover the lessons that will make your investments work for you, plus the mistakes you must avoid if you want to build serious wealth. Imagine you are a 30-year-old professional. Your goal is to build a strong financial foundation over 10 years by investing 50,000 Kenyan shillings monthly. So you start with a mix of stocks, unit trusts, bonds, and REITs. Here's how your journey may look. Year 1 to 2, build the habit, nothing flashy, just consistency. Year 3 to 5, compounding starts to accelerate, your portfolio is worth 4 to 5 million shillings with moderate returns. Year 6 to 8, growth compounds exponentially, you see 8 to 10 million shillings in your accounts. Year 9 to 10, your portfolio reaches 12 to 13 million shillings with aggressive allocation. Wealth accumulation is now tangible. Notice how the real growth happens in the later years? That's the power of compounding and staying consistent, even when returns feel small early on. Here are the most important lessons from investing 50,000 Kenyan shillings monthly. Lesson 1. Time magnifies growth. The longer you stay invested, the more compounding accelerates your wealth. Lesson 2. Discipline beats timing. You don't need to predict market highs or lows, just stick to your plan. Lesson 3. Diversification protects you. Spreading your money across assets reduces risk. And lastly, adjust for inflation. Growth should outpace the rising cost of living. And here's a mindset tip. The last few years of your 10-year plan will contribute the most to your total wealth. Don't allow fear and emotion to derail you. Stay focused on your long-term goal. Patience isn't just a virtue, it's a financial strategy. Many investors make mistakes that slow or destroy growth. Avoid these at all costs. Mistake 1. Stopping contributions when markets dip. Keep investing consistently, even during market dips, to take advantage of lower prices and long-term compounding. This strategy, called dollar-cost averaging, reduces the impact of market volatility. Mistake 2. Chasing get-rich-quick schemes. Focus on proven, diversified investment strategies rather than high-risk, speculative opportunities. Sustainable wealth grows gradually through disciplined planning and patience. Mistake 3. Ignoring fees and taxes. Always account for management fees, trading costs, and taxes, as they can significantly reduce returns over time. Choose cost-efficient investments and tax-smart strategies to maximize net growth. Mistake 4. Not having an investment goal or policy. Set clear financial goals and define an investment policy to guide your decisions. This keeps you disciplined and aligned with your long-term objectives. Mistake 5. Investing too conservatively when young. When you're young, take advantage of time by allocating more to growth assets like stocks. This allows higher potential returns while still managing risk over the long term. Mistake 6. Failing to review and rebalance your portfolio. Regularly review your investments and adjust your portfolio to maintain your target allocations. Rebalancing helps manage risk and ensures you stay on track toward your goals. Avoid these mistakes to grow your portfolio steadily over 10 years. Ensure you have an emergency fund first, 3 to 6 months of living expenses. However, the typical 3 to 6 months of savings may fall short, especially for young high-income earners with steeper living costs. Aim for 9 to 12 months of expenses for greater security. Here's a simple 4-step plan to start. Step 1. Define your investment goals. What do you want to achieve in 5, 10, or 15 years? Step 2. Open an account with a capital markets authority regulated provider. This could be MMFs, unit trusts, or stocks. Step 3. Automate your 50,000 shillings monthly investment. Step 4. Review and rebalance annually, adjust as your life and goals change. Now that you know how 50,000 Kenyan shillings monthly can grow into a strong financial foundation, imagine what happens if you scale it from 50,000 Kenyan shillings to 100,000 Kenyan shillings. Watch my next video. I show you exactly how doubling your investment can accelerate your investment journey and the smart ways to allocate that 100,000 Kenyan shillings for maximum growth.